and welcome along to the Property Academy podcast by Opes Partners. I'm your host, Stephen Knight.
And I'm Andrew Nicol.
And today on the show, we're talking about what is a good cash flow in 2024, because this is one of the main things that property investors want to know, because it's actually been pretty tough for investors over the last couple of years.
Yeah, if you took out a mortgage and you used the no cash needed method where you borrowed 100% to buy an investment property, it would be very, very unlikely that the rent would cover all your costs if you had that full mortgage.
Yeah, and in fact, Velocity, a data company, put out some numbers in June last year showing that 93% of properties, if you bought them using that no cash needed method where you didn't put in any deposit, borrowed all of that money, 93% of them would be negatively geared. It would require some amount of top up over the last couple of years.
And if you're genuinely running the numbers properly, you're including, things like vacancy and maintenance and your accountant and all of the costs that you might have, property management, then you normally had a top up of we were saying around somewhere between $300 to $600 per week to cover all those costs, which for some investors was quite a lot of money, particularly when you think your tenant might have only been paying $600 themselves.
And these days, we're seeing that interest rates are coming down. And so we can reevaluate what a good cash flow looks like. On top of that, rents have gone up. And so let's see what real investors would be paying at the moment. And in the past, we would have figured this out using my return on investment spreadsheet. Now, this was a spreadsheet I created literally a week before Labor came out and changed the interest deductibility rules.
I remember we were presenting at the Canterbury Property Investors Association on the Tuesday night. So when you say a week before, it was probably prepared and ready to go the day before. Then we go up there and they just brought out the interest deductibility rules and you had to redo the whole thing.
Yeah, which was, anyway, it was what it was. But that was 3.5 years ago. And so many people gave me a lot of feedback because it had been downloaded over 18,000 times. A lot of investors around New Zealand were using this. But people gave me feedback like, I don't have Excel, edit's too complicated, I opened it, then I closed it, couldn't figure it out. And so we've just released Opes Plus, which is a free app that anybody can use to go in and run the cash flows on their investment properties and for their whole portfolio. So it's a massive upgrade to what we've had in the past. So let's take a look at an entry-level property and see what the cash flow looks like. Now, Andrew, what would an entry-level property look like in New Zealand?
So I've said if you're going out and buying a property today in Christchurch, you might spend $550,000 and you might get $525 a week rent. So a pretty good yield.
That's about 4.96.
Yep.
4.96.
Now remember, that's your gross yield. You've still got to take off your mortgage plus all your other costs to see what your cash flow looks like.
And so let's say that you use that no cash needed method. You take out a full mortgage in order to buy that, and you account for all your costs like vacancy, rates, insurance, maintenance, all of that good stuff. And let's say it's under construction. By the time that property's built, what does the cash flow look like, Andrew?
So during the first year, obviously, you've just got a deposit loan if it's off plans. The first year where the property's actually complete, you're negatively cash flowed by about $15,000 a year, about $300 a week.
Yeah, and again, that's assuming that you're borrowing all of the money. If you had a cash deposit, it'd be a bit lower. And it's quite interesting, Andrew, because I was reading some comments on Reddit about this podcast, and somebody said that they stopped listening when we had talked about that if you buy a property and it's got negative cash flow, that can still be a good investment. And that statement can sometimes put people off. But the way we think about it is that no investment is free, right? It's going to take something from you. So for example, if you're investing in shares or a term deposit, you either have to have some money up front, whether it be 10, 20, 30, 50 grand, whatever it happens to be, so that you can go and buy those shares or term deposits, or you put aside $100, $200, $300 a week in order to create that investment. Otherwise, how else are you going to buy the shares? And I think with property, there are 3 types of investment you could make into it. You either put in a big cash deposit so that you have a lower mortgage. If you've got a lower mortgage, you've got lower interest rates, in which case the rents, even at today's higher interest rates, might cover all of those costs. The second type of investment is a cash flow top-up where you say, look, I'm not going to put a cash deposit in, but I know that while interest rates are high, the rent isn't going to cover all of those costs. And then the last type of investment is if you get your hands dirty, get in there and absolutely reno the hell out of a property to get that rent up. But then the investment is in your time and your management of that renovation. The old days where you used to be able to just buy any property off the street or a good property off the street and have the rent cover all of the costs, those days are kind of gone now. And so you do have to decide which investment you go for. And I get that in that Redditor's comment, that really turned them off, this idea that if you're paying money into a property because it's negatively geared, that could not possibly be a good investment. You've just got to consider what way or what you were going to put into the property in order to start investing, because there's no miracle investment where you can just buy something, borrow all of the money, put no cash in, and it completely pays for itself. There's going to be some investment from you.
And I think also being really honest with how you run the numbers. So I was working with an investor a couple of weeks ago, and when I did the cash flow, he said, "Oh, these numbers are terrible. What's the yield? What's the gross yield?" And I told him, he said, "Oh, that gross yield's better than what I've been looking at, but I'm getting a different result." So I looked at his numbers. All he was calculating was what's 52 weeks worth of rent minus the mortgage. And he had a top up of kind of $100 a week, say. Now, when I ran the numbers, it was more like negative $300 a week. And so the difference was the fact that I'd factored in vacancy, I'd factored in maintenance, property management, accounting, all the things that, you're going to actually have to pay. So you need to consider them. And so rather than do a back of the envelope calculation, actually do some robust numbers before you invest in anything.
Yeah, it's quite funny because we always say you can make any investment look good if you use unrealistic numbers as well. So that's what a property looks like in Christchurch. If you're being really honest with your numbers, starting out at maybe just under $300 a week, and then gradually improving as your interest rates come down.
And for someone that is buying off plans, one of the things that I recommend is, why don't you put aside some money this year when the property isn't built, so you can smooth out that first year's worth of full contribution. So if you're only paying the interest on the deposit, $100 a week this year, maybe set aside $200 a week, so you've got an extra $5,000 in your bank account next year. Then it's just going to be $200 a week on average for the next 3 years.
Yeah, the other thing that I've been thinking about is there'll be some people who get really excited about the market at the moment because they start to see interest rates go down. They're saying, hey, look, I think property prices are going to be on the up. I just want to go buy something. And if you just want to go buy something and look for a property and calculate your cash flow in the wrong way, like in the example you just gave, Andrew, people might find that they're having to top up this property way more than they actually thought.
Yeah.
Now, let's look at a different scenario. Let's look at a property in Auckland. And in that case, we're going to have a more expensive property. We're going to have a larger mortgage there. So what does a kind of property in Auckland look like these days?
Well, I've used an example of a $750,000 property, which is kind of your kind of mid-entry level value.
Mid-entry level.
I know. I knew you were going to hit me up about it, but like it's entry level, but you're kind of a little bit higher than that. Oh, give me a break. And I've said $635 a week rent.
So we're talking about a gross yield of 4.4%.
So a lower yield, but obviously Auckland often has superior growth, and so that might be why someone wants to invest there.
Yeah, so you typically expect that house prices might go up a bit faster, which is why you might invest. Now, in terms of the cash flow for an Auckland property, again, we're going to assume that this is a new build, that it's under construction. What does the cash flow look like once it's built?
So it's about $440 a week for the first year that it's completely in place. Now, again, if you're buying off plans and you've got 12 months of construction, you might only be paying $100 a week. So again, if you wanted to average that out over the next few years, you're looking more like a $300 a week top up for 3 years.
Yeah, so in the past, when interest rates were a bit higher than they are now, we were talking about that, your average top up, if you're using the no cash needed method, might be $300 to $600 a week, if we're being really honest. Today, with slightly lower interest rates, you're probably more in the region of $250 up to $450 a week. Maybe a bit more if your property is really expensive. But again, that assumes the no cash needed method, Andrew. So let's come to this Auckland property and say we're going to put in a cash deposit. So rather than borrowing all of the money, I mean, how big a cash deposit would an investor have if they come to you?
Why don't you work on $150,000 or plus the setup cost? So let's say a mortgage of $600,000, which would be an 80% loan, which you could get against that property by itself. So what I mean by that is not using any other assets to secure it. So if we bought that property in isolation and borrowed 80%.
Okay, so in that case, we'd be looking that your top up would go down to about $250 a week, maybe slightly more for that investment property up in Auckland.
Yeah, which is quite a manageable amount again for a lot of people to be able to get into that market. Again, knowing that for the first year, if you've paid a cash deposit, you don't have any contributions at all. So you could smooth that out to kind of maybe $100 a week.
And I suppose the other thing that's important to note is that your cash flow on almost any investment property you buy should start to improve over time. And the reason is that when you buy a property, you take out your mortgage, and it is highly unlikely that your mortgage is going to go up. Most of the time, your mortgage it will stay the same if you're on an interest only loan, or it will start to go down. And as long as interest rates are coming down, you're going to see that your cash flow starts to improve. But even if interest rates stayed the same, you would likely see your cash flow of your investment properties improves over time because your largest cost, your mortgage, is staying the same while your rent is going up. And so we typically see that cash flow does tend to improve, which is why you see somebody who's owned a property for 20 years, and even if interest rates go up or down, generally speaking, that property is going to be cash flow positive because the rent has gone up relative to the size of their mortgage. So I always think in property investment, one of the great things that people miss is if you buy, your mortgage stays the same. And so if you hold it for 20, 30 years, your rent's going to go up relative to that. And so you are going to have that great improvement over time. And so I suppose if you compare this, the cash flow conversation we're having this year compared to last year, you're probably about $50 to $100 a week better off from those falling interest rates. And that will probably continue as we see rates start to fall. But counter to that, you're also going to start to see house prices increase, which means that if you end up buying a property in a year's time, you might have to take out a larger mortgage. That means more costs. And so you'll have one positive impact on your properties because we've got those falling interest rates, but then you also have a negative impact on your cash flow because you're going to have to take out a larger mortgage. So that's just something to consider.
And how does someone register for this?
Well, I'll come back to that, Andrew, but the first thing I need to say is that this is the first version of Opes Plus. It's not the forever version. And so a lot of people have been clicking this orange button that says feedback and reporting issues to me. I've had over 100 people give me feedback, things that aren't quite making sense. And so I've got my developers on full blast making changes to this based on people's feedback. So one ask that I've got for everybody watching and listening to this is go sign up. You can get it. You can create your free account if you just go to opespartners.co.nz, click the login button, and then sign up for your free account because then you can test it out, give me feedback, and then together we'll be creating the #1 property investment app in New Zealand.
And we're going to be using this with Opes clients, but this is free for anyone. So you can load all of your existing properties if you've got them, plus any future investment properties that you want to consider. It doesn't have to be an Opes property.
Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the Property Academy podcast. Really does help us get the message out to more people. And hey, if you're listening to this on Spotify or Apple, you want to see some of the screens that Andrew and I are looking at, you can just Google Opes Partners YouTube. It'll be the first thing that comes up. If you're watching on YouTube, make sure you hit that subscribe button. We're really trying to grow the channel to 20,000 subscribers. Thanks for listening to the Property Academy podcast. I'm your host, Stephen Knight.
And I'm Andrew Nicol.
We could be back here tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.